Okay, so we talked about the cover call. There is another topic I wanted to address. It is 5:51 p.m. Eastern Time. If anyone has any last-minute questions, go ahead and send those in. I wanted to cover one comment that came in real quick here, and it was related to Sean. He says, I saw a video in Fusion about Kurt talking about how the covered calls are not better than a married put. Okay, and we've talked about some of those scenarios when you're talking about at the money or out of the money covered calls. They don't give you as much protection. And with the married put, we have the locked in protection and the ability to sell calls later, just as you do with a covered call. But in any case, let me go on with this comment here. I'm proposing of doing this slightly differently. My idea is to start with the trade with, let me write this down, one strike ITM, a covered call, one strike ITM, with a short call 2 weeks out in time. The idea is expecting the profit in the trade to be no more than the premium received. Okay, yeah, of course. But importantly, the loss be restricted to this amount to such that the trade is closed out at the break-even value. If I can attain 1.5 to 2% premium, I'm looking at a 48% profit. If I write a trading plan carefully, this strategy can be implemented and will allow me to invest in the market during current very overbought situations that otherwise kept me out of the market. Okay, there's some faults in my opinion, and anyone feel free to correct me if you think differently. This approach he's talking about is I want to do in the money covered calls, one strike in the money covered calls on stocks where I'm selling just 2 weeks out in time. Okay, so let's take the in the money default screen on PowerOptions. I'm going to do two things. We're going to change the expiration, of course, to match the 0 to 15 days out of time. I'm going to put 1 to 15 days, Sean, real quick. Now, this was the monthly covered call screen, so I've got to lower this down to 0.5, and I've got to lower the percent if assigned down to 0.5 as well. Now, doing covered calls, we want to have some criteria, and we have some in here. We're looking for earnings per share growth greater than 7, a PE of 0 to 70, price to sales less than 10, stocks trading above their 50-day moving average. But likely, because you're worried about a black swan event is what you mentioned. And in a market downturn, Sean, the stocks that are going to react faster are the ones that have implied volatility, meaning the market falls 7%. Those with the higher implied volatilities and stock volatilities are going to be dropping 15, 20, perhaps even 25%. So we want to look for some more stable securities that are potentially offering the return that you're looking for, in my opinion. And if I put in to look for mid to large cap stocks and I look for an average stock volume of greater than 750,000 shares per more, we are avoiding earnings between now and expiration. That's good. We've got those other basic criteria there, maybe a good MACD crossover over the last 2 or 3 days. So let me run that search real quick. There's 26 total trades. 2 weeks out, 14 days. GE, 0.5% return. Seagate, okay. Okay, we wanted to go one strike. I apologize. I sincerely apologize. I got to isolate it to one strike in the money. Okay? There we go. That's what I was missing. My apologies. There we go. Much better. Okay. So now you've got positions. You see some good ones in here. Micron, 90.96, and the 90.50 is considered one strike, Sean, because that is 50-cent strike differences. I'm tempted to go with percentage here because these are not really one strike in the money. These are all at the money because everything's offering 50-cent strike differences now with the weekly. So this is technically one strike in the money, the 76 to the 75. But the 12, this is one strike in the money. One strike out of the money is a 12.50. So let me make that adjustment. Instead of strikes in 1 to 1, let's go 1% in the money. Maybe I could go to 2. Let me try 2. Maybe that's just the way I have to do it. Let's just do 2 to 2, Sean, okay? I'm sorry about that. 18.98 and 18, I'll accept that. 12.02 and 11.50, I'll accept that. Good. This is more along the lines of what I'm showing you. These are more what I consider one strike in the money because I'm trying to ignore the 50-cent strike differences. Okay, Flex has a return of 2.2%. GE's 1.2. Alliance 3.8. Micron 3.3, Skechers 2.2, Okay, so there's a lot of ones here. There's only 26 total results, but that's perfect. Okay, because your downside protection is still a good 3, 4, 5%, in this case 7% with this premium up here. But if you have a 5% decline in the stock, you're going to have, in these situations, a 1.6% loss, 1.2% loss. You're taking out 1 to 1. Each loss you take is taking out 1. If you have that stock that's more volatile, some 0.5 implied volatility is not great, but not terrible. In this case, you see one of those hits you, Sean, it might take out 3 previous trades. In other words, this stone here falls 10%, you're down 5.8%. That's taken out 3 of those positions at the 2.2% return, or the 1.5% return you're mentioning. All right, well, let's put it into context, shall we? I'm going to save this search. We're going to call it S, covered calls. It's today, 219. All right, let me save that. And why do I want to save that? Because we're going to go back in time, as always. We're going to go into the back test. Go to Smart History Excel. And I'm going to search on September 1st or 2nd. Doesn't really matter. I'll say with the 1st. And we'll do your search. This isn't even a black swan event. Remember what happened in September? Right after the first 8 days or so, the market started to turn, and September was actually down 9% over the course of the month, general market as a whole. Goose, Foot Locker, General Motors, okay, 24.92 to the 24 strike. Yeah, with single strike differences, it's 1 strike in the money, a 1.5% return. Foot Locker, 2.4%. So you're in your wheelhouse here. You're in your 1.5 to 2% gains. All right, so for the first 14 days, from September 1st, which was after a holiday, so it's actually 10 days. It started on Tuesday, right? Does that sound right? Yeah, Memorial Day and everything. Anyway, 10-day out expiration, the first 2-week cycle from September 1st. Let's run it. So this was to September. Go. Okay. Not bad. 9 out of 12 were successful, but the average return is only 0.8%. Okay. And so even if you took the top ones, you might have been expecting a 1.5%, but you only got 1.1 because the stock pulled back. You might have been expecting 2.4, you got 2.1. Right? Market changes, market fluctuations. Had 3 losses only. You were right 75% of the time, but you took out half of your expected premium. You're at 0.8%. This is what would have happened in the real market. Now, got that down, 75% success rate at 0.8%. Next cycle, we would have opened covered calls following that expiration. So I believe on the 13th or 14th, excuse me. Yep. Let's run that search there. Some common stocks, Foot Locker we saw, Discover's there now. That's all right. Let's calculate those group results in this case. Now, you wouldn't be doing all of these trades, I understand that. You wouldn't be entering all these trades, Sean. We're just trying to gauge if this is a good principle. In the last time, and October was actually more quick. The October decline was more quick and then rebounded faster. But September was that gradual decline. So in the second cycle for September, ending on September 25th, you only had a 45% success rate. And you lost 0.5%. So out of the first month, you're at a 0.3% gain on the position, on the structure. This is, so you see here, this is where we're emphasizing you don't necessarily get all of the wins in a market, and this wasn't even a black swan event you're saying you're worried about. But again, why wouldn't I go deeper? If you wanted more protection, could I say you'd go deeper in the money? Well, if you did, then you'd be looking at only a 0.3 or 0.5% expected return. So now on the one stock that does have that 10, 12% decline in a bad event, might have broken through your break-even point and taken a 5 or 6% loss, which might have wiped out close to 10 or 12 previous trades. That's the risk with the covered calls and the open downside. One strike in the money is not really enough to give you a high downside protection. We saw some 7%, we saw some 3% in there, that's true, 6%, 4%, but you're still losing on those. And since you're playing such a tight battle to the vest, where honestly a 1.5 to 2% return, we saw those with going one strike in the money, but to get the better protection, if you're worried about a market decline, Sean, you got to go a little deeper in the money. But now you're only looking at a 0.8, 0.6% return if assigned instead of the 1.2, 1.5, or 2% you're concerning. That's the trade-off. Okay, that's the trade-off that we're talking about here, is to go deeper in the money to get, a higher downside, and a break even means we're only going to a 0.5% return if assigned. I'm just trying to illustrate for you, this is one of the reasons why that's said. Most of these returns were all right where you wanted them to be. 1.6, 3.0, 1.6, 2.3, 2.6. But the actual outcomes, as you can see over time, with the wins and the losers, after the first two cycles of the 2-week plan trading we saw, and yes, I'm using a declining market here, you're only 0.3% up. 75% success rate the first cycle and a 45% success rate the second cycle. You're actually above a 50% success rate combining the two, but you're nowhere near your targeted capital, and that's the way the covered calls work over time. We'll talk about this more, Sean. I already answered your initial email that you had sent in. I wanted to put this together for you to give an example of what to possibly expect in different market conditions and how these pan out. I'm not saying your approach is necessarily bad, and if it makes you comfortable, it's okay. But you've got to kind of expect that if you're worried about a black swan event, I'm just showing you a pull down market in September, which we wouldn't call a black swan event at all. You're still nowhere near your targets, even though you found positions that were in an uptrend, quality positions, had the percentage return that you were looking for, and had good downside protections of 3, 4, 5, and 6%. And it didn't pan out the way that we expected in a stable to declining market. Okay, this was declining, not really stable, but it didn't really give you the full effect you wanted. Many investors will tend to go deeper in the money and further out in time for the higher downside protection, maybe going 1 month out and 3 or 4 strikes in the money if they can still get a 2% return for 1 month, not every 2 weeks. Premium just isn't there really to isolate it and give you the protection that you want. And the movement, as you can see, the subtle movements of the stocks can take out a small position. Okay, it's only a 0.3% loss. Well, that wiped out the 0.1% gain because you didn't get the full assignment, but you were still above break even on this trade. It's a wash. Okay, that's what ends up happening with these shorter term trades, where just a little bit of movement can get you underwater, get you to break even, just a smaller profit than you expected. You're not seeing the maximum profit as often as you'd likely expect to. And that's my concern. As again, I mentioned, that's my concern for the approach that you outlined to me. And one of the reasons why we say this is why we use the married puts, looking longer term with the protection in place, as opposed to trying to force a position that looks like it's giving me the return that I want, but in real market conditions doesn't. All that being said, of course, that Ernie has the weekly picks of the day that he tested, okay, that he ran through, and he shows you here what he expected during his trading cycles, this different market trend that he traded this criteria for. And where's the number there? Oh, yeah, it's a 24% return over the course of 1 year, 104 trades over 52 weeks. 77% of the trades were winners, with an average of 2.3% on the wins, 3.2% on the losses. So you'd think if he's doing weeklies and getting 2.3%, and 52 times 2.3 average on the winners, shouldn't it be at 100%? No, it's 24%. That's your expectation, best case scenario with a covered call. But you got to be right 77% of the time. And a lot of times, even with the downside protection you're talking about, because Ernie's positions have high downside protection, those stocks will tend to fluctuate. And I could have a 7% downside, but if it drops 10%, I have a 3% loss, took out a gain. I have a 15% decline, and I can't catch it. You had also mentioned being able to try to stop the position when it hit break even. Well, the break even, Sean, is only the break even at expiration. What do I mean by that? Is that right now I'm underwater when I open the trade. I can't every trade I open, I can't close for no loss on the trade. And the reason why is because right now I'm underwater. If I open this trade today, just due to the bid-ask spread, I'm below technical break even. This break even of 1136 is only true at expiration. Yes, I know you're using a shorter time frame, but if the market opens on Monday and GE is down to 1136, Monday the 22nd, Monday's the 22nd, I still have time value on this option. Okay, it's the stock falls. It's not going to zero. It's still going to have time value remaining that I have to pay to buy back to liquidate. So I'm at a loss here of 22 when my max expect profit was $14. This break even is only at expiration. The true zero value is changing every day because it's taking into account the time value. So if it hits break even, you're still going to be at a loss. Is this a large loss? Well, it's a little bit more than double the expected returns. It'd be about a 2% loss on this investment. That $22 is going to be a 2% return on our investment of 1136. So that took out the next trade that you'd make 1.5, 1.8, or 2% on. They're a wash. If you hit your break even on the first day, and if you hit it at the end of next week, the 26th, right? You're still down more than you expected to make. It's 1750. So you're probably at a 1.5% loss, just as we saw with the back test that takes that out too. Okay, that would take out those potential gains that we saw with the back testing in the smart history. That's what I'm kind of referring to. That's what Kurt was referring to when he said that is the pros and cons of the covered call. This is why Ernie developed the picks of the day, to put his best foot forward to show how to potentially be successful and what kind of gains you would need. You don't need to be right 60% of the time, 65% of the time in a covered call. It's closer to 73, 75, 77% of the time in order to profit long-term with the targets that we're looking for. And that's 15, 20, 25% per year. The type of return you're talking about, even using weekly options, you're going to need to be closer to an 80% success rate, 85% success rate, more along the lines of bull put credit spreads with that kind of risk-reward ratio. Okay? Those are the subtle differences in the strategies. Covered calls are not a bad strategy. In the money covered calls are not a bad strategy, but the downside is still open if the decline in the market exceeds what your fears are, where you can still take losses that are wiping out the gains and keeping you from achieving your trading plan goals that you had mentioned. And I think we illustrated that and how that works over time. Even though we just looked at a snapshot in September, the market's fluctuating up and down all the time. And so that little snippet I gave you, that little window, is very similar. We might see 3 or 4 months of good covered call returns you're expecting, then 2 months of bad. You're right back to square one, right back to where you started from after 5 months of trading. That happens often. That's the nature of the structure of those trades. Well, ladies and gentlemen, I didn't see any other questions came in aside from that discussion we just had with Sean, I should mention. And it is a little bit, I'm sorry, folks, it is a little bit after 6 o'clock here Eastern time. There we go. Sorry about that. So sorry, PowerPoint didn't do what I wanted. I apologize. Yeah, so I just wanted to remind everyone that today's material are my thoughts and your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as recommendations or direct trading suggestions. Options, of course, do involve risk, may not be suitable for all investors. If you like some of the tools that you saw today, we talked about the search. We showed you using a little bit of the backtesting tools. We showed the portfolio tools for evaluating rollout opportunities and comparing gains and losses between different types of strategies. Simply go to powerop.com, put in your name and email address. You'll have full access to the site for 14 days. You don't need any credit card information or billing information. You'll access the search tools, detailed research and analysis tools, the signature tools, portfolio tools, and more, completely free for 14 days. After that, the subscription level start is just $45 per month for end-of-day data. The most common subscription level is delayed service at $65 per month. At any level of subscription, we also offer real-time, I should say, as well. Any level of subscription, you can cancel at any time. Free coaching sessions are available on the trial or on any level of subscription. You can also upgrade at any time as well. For more help information, of course, you can go to powerop.com/webinars.asp, or just go to powerop.com and click on webinars, and you'll be able to see the archive webinars page where many of our webinars, of course, are held. Every webinar typically is posted on our YouTube channel. Just go to YouTube, look up Power Options, and you'll be able to see it there and scroll through all of our recent Friday sessions. Many of them are available on the archive webinars page, but most of them, all of them, are available on YouTube. To answer the question from Eli earlier, we'll start converting the webinars sometime later this evening. If I get time late tonight, we'll get those first 2 segments cut and put up as well. And there's only 4 or 5 questions today, so we might actually be able to get through all 4 of them pretty quickly. I'll let you know, but I'm not going to make a promise. Something will be up tomorrow, probably by 1, maybe 12 noon, 1 p.m. Eastern time. And if not, all 4 will be available for you at some point tomorrow. They'll be available on YouTube, and most of them will be available on the archives page as well. If you think of any other questions, just send me an email at any time to support@powerop.com or support@radioactivetrading.com as well. Remember, you can also call us during market hours at 302-992-7971. And of course, trial members and subscribers can schedule a coaching session at any time. That's essentially a 35 to 45-minute phone conversation with myself